March of 2025, the number of mutual fund investors in India came up to 5.43 crores.
Mutual funds.
Mutual fund.
Mutual funds. Mutual funds.
This is a 22% increase as compared to last year's numbers at 4.45 crores. Crossing the 5 crore mark is not just a numerical achievement, it shows the evolving investment landscape in India. So it's no surprise that we have a large number of mutual fund options. As an investor, choice is not always good. The sheer number of mutual funds is enough to cause a lot of confusion. But don't worry, today I'll give you the ultimate 3-step formula to pick the right mutual fund in 2025 without any confusion. This is what this video is going to be about, how to pick the right mutual fund. But before we dive into the details, why should we even worry about picking the right fund? With over 1500 mutual fund schemes in India, choosing the wrong one can literally cost you lakhs in lost returns. The 3-step formula. 1. Identify goals. Before investing in any fund, you must first identify your goals for the investment. Is it growing wealth? Is it keeping money safe? Is it saving tax? This alone will eliminate 80% of your unnecessary options. If you want growth, it is equity mutual funds. This would be large cap, mid cap, small cap, index and flexi cap. Equity mutual funds are one of the most popular types of mutual funds. These funds mostly invest in stocks or equities of companies that are listed on the stock market. While there is growth, the performance of these funds depends largely on the companies in the mutual fund basket. So stability is not necessarily a priority. But if you want stability, there is debt mutual funds just for you. This would be liquid, short-term, gilt and corporate bonds. A debt mutual fund pools in money to invest into fixed income instruments like government bonds, corporate bonds or treasury bills. It's like lending your money to earn interest, but with the help of expert fund managers. But if your goal is tax savings, you have 3 option equity-linked saving schemes. Equity-linked saving schemes are mutual funds that invest mainly in stocks and offer tax benefits under Section 80C. They have a 3-year lock-in period and aim for long-term wealth growth through equity exposure. Once you are done with identifying your goals, go to step 2. But before I go to step 2, comment your primary investment goal in the comment section below. Step 2. Understand your risk appetite. To assess your risk appetite, you start by asking yourself a few questions. 1. Can you have a dramatic swing in portfolio value? And 2. Is a more conservative investment more suitable? But what exactly is risk appetite? Risk tolerance is the degree of risk that an investor is willing to endure given the volatility in the value of an investment. An important component in investing, risk tolerance often determines the type of amount of investments that an individual chooses. For a low risk mutual fund, we have a large cap equity, index funds and debt funds. And for medium risk funds, we have flexi cap, balanced advantage and hybrid funds. And lastly, for high risk funds, we have small cap, mid cap, sectoral and thematic funds. Once you understand your risk appetite, go to step number 3. Check performance, expense ratio and your fund manager. Step 3 is to know more about the fund that you're investing into. So how do you do this? There are 3 ways. 1. Compare the fund's 5-year performance against its benchmark. Basically, if the graph is going up, it's good. 2. Check the expense ratio. The lower the expense ratio, better it is. Higher the expense ratio, lesser is the profit for you. 3. Check the fund manager. If the performance of a fund manager is consistent, then it's a good sign. Now that you know how to pick the right fund, here's an example of a well-diversified mutual fund portfolio for 2025. For high-growth investors, 70% equity, which will include mid-cap, small-cap and index fund, and 30% debt. For balanced investors, 50% equity, which would include flexi-cap, large-cap and 30% debt, plus 20% hybrid. For low-risk investors, 30% equity, which would include index, large cap and 50% debt and 20% hybrid. Now imagine this, it's 2030 and your investments have doubled, all because you picked the right mutual fund today. I'm Jeff Curtis, and if you're serious about building wealth through mutual funds, hit that subscribe button for more game-changing finance content from InvestEd by FYERS.